How's it going, crypto community? This is Jade Martian, and I'm back, finally, after a long delay, with the next part of our SNB research conference breakdown. And in this video, we're going to be listening to Tobias Adrian, who is the financial counselor and director of the Monetary and Capital Markets Department at the International Monetary Fund, right? So he is obviously a big dog here in the space, and I can't wait to see, for you to see really, because I've already watched this, how Adrian approaches the future of finance and blockchain technologies in general, right? So, if you haven't already, before we hop into this, please be sure to hit that like, make sure to smash that subscribe if you're new, and if you really enjoy this kind of content, be sure to ring that bell so that you can be kept up to date with all the in-depth breakdowns that I bring to you, as well as news articles. So, without further ado, let's jump in and see what Adrian has to share with us.
Great, thank you so much. Just a year ago, all the talk was about crypto assets, Bitcoins, and its multiple evolutions. And today, I'm going to shift and talk more about e-money. In particular, I'm going to focus on stable coins and how they relate to central bank digital currency and what it might mean for the international financial system. So I've written up my remarks in a kind of speech that is on the IMF website in case you want to go into a little bit more detail. So I'm going to broadly talk about e-money. And what I mean by e-money is that it's a means of payment and store of value that is fully backed by fiat currency. So it is the digital equivalent of a prepaid card, and there are many different forms of e-money. It could be in token form or in account form, and it could be centralized or decentralized. So one particular e-money that I'm going to focus on are stablecoins. So stablecoins are token-based coins that are fully backed by the fiat currency in some bank account so that they overcome a lot of the problems that Charles was pointing out about the crypto assets. So these are stable in value and they can be used for transfer in the digital world basically for free. So the transaction costs are extremely low.
So let's be clear real quick before he continues on, because obviously it's going to be a long-winded remark. I just want to simplify what he just said for you, right? This conversation is obviously about stablecoins and how CBDCs are technically just stablecoins, and that the importance behind such is that they can peg these to the current economy, the fiat economy, and that provides an illusion of price stability based upon the fact that these stable coins are pegged at a one-to-one pair to whatever fiat that they are pegged to. So the stability of that asset is wholly dependent upon the stability of the fiat that it's pegged to, which at present, the fiats that they're likely talking about actually creating pegs to are for the most part stable and not hyperinflating into oblivion, right? That said, obviously, we don't know how this is going to play out. We have our speculations, but that's not what we're here to discuss right now. We're here to hear why Tobias Adrian is so gung-ho about central bank digital currencies, right? And why these stablecoins are so valuable to the traditional financial institution in regards to adopting them.
So examples of e-money, so these are all different types of e-monies, for example, WeChat Pay and Alipay in China, M-Pesa in Kenya, Bitcoin in the Caribbean, or the US dollar coin of Coinbase and Circle in the US. So for example, in Kenya, 90% of the population is using M-Pesa. In China, something like $18 trillion of e-money transactions have been done which apparently is more than what Visa and MasterCard did combined. So e-money already has a big presence in some countries around the world, and there continues to be innovation in this area.
So again, to conclude, not only are these stable coins, as he's referring to them as e-money, not only are they something that has the potential to be widely adopted and used and effectively serve as a rapid road into the blockchain ecosystem, which can facilitate rapid cross-border payments, right? But it's not just that, what I just shared with you, but also the fact that this is already happening and happening at a large scale, as he pointed out, in places like China, where we're now seeing, trillion plus dollars being moved, right?
So, as I said, the advantage of the e-money is that it's stable in value, so it doesn't have the Bitcoin problem where the value of your supposed coin is 3,000 one day and 6,000 the next day, or vice versa, which is worse. And of course, e-money is completely integrated into the digital life, right? To the extent that you are, probably the younger you are, the more your life is totally digital. And so e-money is integrated in internet companies, basically. The transfer of e-money is near costless and immediate per construction. And in principle, because these are fully backed coins, there should be trust in these coins, right? There are network effects as well. In principle, size helps a lot in this marketplace. Of course, these are not riskless. There are lots and lots of risks. So at the IMF, we worry about all of the risks all the time. So the first one is that perhaps the e-money is not fully backed. There are incentive problems, as Charles pointed out. So, as a company that is offering e-monies, you always have an incentive to under-collateralize your coin. And who is there to really check that all these funds are out there? Secondly, there's credit risk, right? I mean, presumably the issuer of the e-money also does some other business. And if that other business goes into bankruptcy, your collateral, your e-money collateral could be absorbed into these other parts of the bankruptcy proceedings. And thirdly, there are interoperability problems. So it might well be that Charles and I, we're on the same platform and we can make payments, but Ahmed and I, we are using different platforms and we can't make payments. So how does interoperability work? Of course, within the traditional financial system, this has been solved, but in the new technology, this hasn't been solved.
Well, it hasn't been solved because it's not yet been implemented, right? And what he is talking about there, this interoperability, well, there just so happens to be somebody on this panel who interoperability is his favorite word, right? And I think he's sitting about 3 seats to the left of our buddy Adrian, or Tobias Adrian here. Seriously though, it astonishes me that so many people tuned out most of this press conference because they weren't hearing Brad or somebody directly talking about Ripple. But the whole conference is on blockchain technologies, as anybody who's watched the previous parts has come to that realization, I'm hoping. And I know that this may be boring for some of you to listen through what he's sharing, but again, the monumental basis behind his words is that there is a lot of miscommunication and mismanagement of funds in our current system. And though these CBDCs, these central bank digital currencies, can have a profound benefit to the ecosystem, as he just pointed out, if there's not interoperability between these systems, then we will face very similar problems to what we do in the current financial system. His he assures that, the current financial system has found ways around this, but those workarounds, as many of us who have researched in depth now know, those workarounds still take days, because that workaround system is Swift system, which is now being replaced by RippleNet, and that's exactly why we're sitting here listening to this 9th level high advisory meeting taking place, or that took place, because this surge of technological innovation is rapidly renovating the financial industry, and it's time, as these individuals are making clear, for everybody to really start looking towards that future, unless they wish to become a part of the past, right?
So one solution that you could propose, and here this is where I move towards CBDC, is that, of course, central banks could come to the rescue. So they could solve all three problems that I pointed out. So number one, they could somehow certify that there are enough reserves. So imagine that there are stable coins or so, or some other e-money, where the reserves are not held by a private bank, but somehow either by a central bank or by a specialized intermediary that can hold reserves with the central bank. So at that point, such a specialized license could have a check on whether the money is fully backed. So that would solve problem number one. Problem number two was about the credit risks. So there could be some legal provision that basically whatever reserve you hold against your stable coin would be exempt, would be super senior in bankruptcy. So that's the second problem. And then the third problem about interoperability, well, this is core central banking business, is to ensure interoperability. So there could be in principle some standards that would make sure that Charles and I and Ahmed and I, we could all sort of like transfer these e-monies due to standard setting.
So again, the standard setting is what? RippleNet and its underlying protocol systems, which link banks together via the XRP ecosystem. Now, something I didn't touch upon was also the fact that I think just reiterated there, but he had touched upon earlier, if not, the fact that in the case that a financial institution which is utilizing one of these CBDCs, encounters a debt crisis, where they need access to a large pool of liquidity. They could source that liquidity via XRP, or whatever, the more obscure term that he's using for that liquidity source, right? So we know that to be XRP, obviously, because that's why Brad Garlinghouse is sitting here, and why we have heard many individuals that came out of this conference afterwards who prior to such were critics of blockchain, now becoming adamant supporters, and not just being adamant supporters of blockchain, but are now using the technical jargon that Ripple Labs enjoys utilizing, right? They have their own terminology for a lot of things in the blockchain space, and that's really what enables many of us who are journalists in the space to actually find out, okay, is this financial institution talking about blockchain in general, or are they talking about blockchain as if, they had just met with Brad Garlinghouse or somebody from Ripple, because they're using the same language when talking about blockchain that Ripple uses, as opposed to using, Bitcoin or Ethereum lingo for these systems. So, at any rate, I just wanted to also add on the bit about the fact that they're seriously engaging in how they can finance debt by injecting essentially value into the Ripple ledger system. That's essentially what they would be doing during these debt crises, is they would be printing money from the bank to put into the digital reserve, which would increase their which is essentially them paying off their debt to the ecosystem, right? That's a really, I feel that's a kind of a poor way to explain it, but I feel that that's the best way for somebody who doesn't understand these complex systems to really kind of process it, right? It's like XRP is the bank's bank, and so whenever the bank has debt, that debt is to XRP, to the bank's bank, and so they have to pay that debt down, and they do that by increasing the value of XRP by decreasing the value of their centrally distributed, their central bank distributed digital currency. So let's hop right back into it now that I've hopefully clarified some things for some of you.
So what I've described is a form of synthetic CBDC. It's not the pure CBDC that Charles described. So what I have in mind are some sort of stable coins where reserves that are fully backed by reserves, and those reserves either directly or through an intermediary, a specialized intermediary, are held with the central bank.
And again, I know that I literally just said this, but he just reiterated again that these CBDCs will all be individuals for regions, and they will be backed by a fund. And what is that fund? What is that backed fund? Well, the backed fund is a fixed currency that cannot be, a fixed store of value that cannot be manipulated, or that cannot be, the supply cannot be altered, right? That it can't be artificially inflated or artificially increased, right? Any value that they put into the system through printing dollars and printing CBDs to dump into it, that's value that the only way that it can be extracted from that network is to pull that value back out, right? And so there's no way for them to really, for any one organization that's engaging with this specially designed system that he's referring to manipulate the base, the greater ecosystem, right? They have to operate within the rule set that everybody agrees upon when they enter into this ecosystem.
So it's synthetic CBDC because the central bank is not involved in any of these businesses of actually running a coin. This is completely outsourced, but they do make sure that there's enough backing, enough reserves, and they do make sure that there's interoperability. All of the risk management, the KYC, AML, CFT problems, and the marketing, all of this is done by some companies. So de facto, this synthetic CBDC is a kind of public-private partnership in some sense.
And so again, to reiterate what he's saying is that the banks, these CBDCs, will be front-facing consumer currencies, while Ripple, XRP, the background technology, whatever they really use, again, I'm saying it's Ripple, I'm saying it's XRP, because to me that seems obvious, but the obvious isn't always obvious, and so there could be a smokescreen. Maybe these guys are developing something off XRP ledger. Maybe they're just literally just using Ripple and saying, hey, yeah, we like your stuff, but once it comes push to shove, we're gonna start up our own network where we just create a chain. We create a fork off of the XRP ledger, and we're just gonna use that instead. We're not giving these people money. That could very well happen, right? That could very well happen. I just don't think it's going to happen, because of the degree of cooperation and how long these agreements have been going on between these individuals. But anything could happen, guys, and that's why that's why I'm here, to give you both sides. But at the end of the day, that's just me playing the other side. I don't see that as a very real potential, just a potential, right? Now, as Adrian pointed out here, the banks, again, they're going to be these front-facing institutions. And what is really important about what he said there is that, even though the central banks are not going to be responsible for the maintenance, the possession and storage and development of this liquidity solution that we're talking about, they will still be the advertisers, the ones that go and ensure that storefronts are able to connect up to this larger, as he likes to say, synthetic CBDC, right?
Now, this all sounds good in some sort of closed economy, but once we think about the open economy, this is becoming a lot more difficult. So even if it was the case that, say, in country A and country B, you could have stable coins where the reserves were held with the central bank or with an intermediary that was holding them at the central bank, you might still have the problem that if you wire money from one country to the next country, you would somehow have to readjust your reserves. And how do you do that? Well, there you're ending up with some sort of correspondent banking problem, right? Because now your reserves that are held with one central bank have to be transferred into the other central bank. And at that point, how do you verify that you have enough reserves in the right currency? Would you perhaps concentrate just on the major currencies and leave out smaller currencies? And would there be a counterparty credit risk because your foreign counterpart might not be under the same law and under the same regulations as the domestic counterpart when you're transacting across borders? So there are a host of issues about fragmentation, again, interoperability, correspondent banking, that are coming up. One particular risk that I want to point out, and this is true even for the stable coins that are present today, so even if stable coins are not backed by CBDC, is a higher risk of dollarization. So there's a natural bound to how much dollarization you can have in a given country, because typically transaction costs are high, and it's actually difficult in a foreign country to say transact in dollars or in euros or in renminbi or so. Once you go into this digital world, dollarization is a lot easier and is potentially a lot cheaper. And so this could undermine monetary policy in countries where there is a push towards dollarization. This is particularly a worry in countries with weak policy institutions, etc. And so what I've been talking about in a global context then are risks of fragmentation, of undermining the domestic monetary policy system, of international payments, fragmentation, weak institutions, etc. This is all like the bread and butter of what the IMF is about, right? And as a result, at the IMF, there is an increased effort to do surveillance on this particular topic, and there are requests for technical assistance on fintech and on CBDC in particular. So clearly the IMF can help in terms of its analytical capacity and its convening power. But if you think further into the future, if such sort of coins would become more important in some future monetary system, there surely will be further implications for the international monetary system. And some people have played around with the idea of digital SDRs or ESDRs, and whether there might be some role for SDRs that is different from the very, very confined role that SDRs have today. So certainly, wherever we go, monetary is going to become more important in the future, I believe, so that the International Monetary Fund, the monetary part of that, will probably be more prominent over the next 10 years than, say, over the past 10 years.
So, what he is getting at overall, again, is that the system as it stands, even with the introduction of CBDCs at present, is still highly fragmented, and the playing field is not at all level or equal, and this inequality is exacerbated on both ends, right? It's not just the impoverished nations that are struggling as a result. It's first world, economic powerhouses that are also struggling, because the system that we utilize that is based upon federally centralized, nationally centralized currencies is ineffective at distributing the burden of trade upon all parties equally, and thus there are how best to word it, it's like the notion that, you will never be the best. There will always be a bigger fish out there. Just like your life is not the worst, no matter how bad it may be, because somebody has something worse going on, right? So the idea is akin to that, in that whether you think that you're getting shafted or somebody else is getting shafted, the reality is both are probably getting shafted, just in a different way. And both of these ways are detrimental to those economies. And it is by and large due to the fact that we have, at present, a global standard reserve that also serves as one nation, the United States, national currency. And this creates infighting over the currencies and the medium of exchange value, the value exchange rate, rather, between the US dollar and other traditional fiat currencies, right? So it's a very complex environment that, these people are operating within. And I believe, my belief is that what Adrian was really doing with this bit at the beginning is to open up everybody into the room to this global system that we're in right now. It has many of the same risks inherent in this digital system that is being developed now, this digital economy that's being developed, but that there are many benefits that can come as a result of this transition, right? So I think that's probably good enough a summary of what he said. Hopefully that helps anybody that was confused by his words.
With that, thank you.
So thanks very much, Tobias. That was really interesting. As you were saying before the conference started, I mean, a lot of the issues here revolve around the details of the design of a CBDC or a digital asset. So it'll be interesting to hear the thoughts of others that have investigated this. Our next speaker is Ahmed Al-Khalifa, who is the governor of the Saudi Arabian Monetary Authority.
And there you go. So Ahmed will be our next video. I can't wait to jump into that with you and also share a little bit of background insight into Ahmed and the Saudi Arabia Monetary Authority that is, as many of you may or may not be aware, a Ripple partner, right? Isn't it brilliant that we're finding out that everybody on this panel is actually a Ripple partner? But nobody wanted to take that into consideration when we first watched this month ago when it first aired, right? And that's by and large because, as I said earlier in the beginning of this, most people are only interested in hearing the buzzwords that they know to be associated with crypto, blockchain, and XRP in general, right? And so really these deep dive series where I go into breaking down these financial panels and meetings and interviews with highly prominent individuals, again, ultimately they are to help you as my viewer come to a better degree of respect for what's really going on in our global community and how blockchain is taking a role, is basically stepping into the driver's seat of this change that we're seeing around the world, and how the gentleman up there on this panel, to the far right of your screen, but the far left of the panel, is at the head of that vehicle. He's the driver in the driver's seat of that whole thing, right? So I can't wait till we get through into Ahmed and eventually Norman Chang's portions of this. Brad Garlinghouse, as many know who have watched this, he has a very small role in this panel, but we will still be covering that during the Q&A segment when he actually has a fair bit of talking time. But for now, that's all that I've got for you. I hope you enjoyed hearing Tobias Adrian from the IMF speak on his feelings regarding digital assets and the potential inherent in blockchain and fintech technologies that are being developed by Ripple Labs and other institutions, right, that are not present at this meeting, but that we will assume may potentially have some degree of engagement, right? But, that's just me trying to help pander, I guess you could say, to the larger ecosystem. Oh, and anybody that hasn't already noticed, hey, check out who's in the audience there. The beautiful representative, the director of the IMF, who we just finished another video deep dive video series on, right? So, as always, I've been Jade Martian. If you've enjoyed my content, please hit that like, smash that subscribe if you haven't already, and especially ring that bell if you are sitting here listening to me still, right? I'm surprised that you've managed to listen through my narration here at the end where I've just kind of gone on a tangent, but I really appreciate all of your support, every last one of you. That's why at the end of these videos I try to frequently shout you guys out and really thank you all for the constant positive feedback and vibes that you're sending my way. It really means the absolute world to me. I'm so grateful that I have so many people tuning into me, and I've only been at this for about 2 weeks, so I hope that I can continue to keep you all engaged and entertained and confident in your investment, right? But without it being a confidence that is, hypey or unrealistic. So as always, I've been Jade Martian. You've been watching The Martian Report, and I can't wait to see all you, my XRP Martians, up here on Mars.